Welcome to the Dev Journal. I am Sloan. We are watching a significant pivot in the landscape as the race for pure model scale is replaced by a drive for agentic efficiency and resilient training. Market leaders are facing a genuine reckoning as they try to justify massive margins against increasingly overbought technical indicators. We will explore how open artificial intelligence is responding with their generative pre-trained transformer 5.5, a fully retrained agentic model that just cleared 82.7% on the terminal bench test. We also have a major context breakthrough from DeepSeek version 4 using compressed sparse attention.
Sloan, those context handling feats are impressive, but the real engineering hurdle is keeping those massive clusters running. Google DeepMind is claiming 88% Goodput with a new asynchronous training method. It suggests we can finally scale across unstable distributed networks without the entire job crashing when a node goes dark.
That resilience could change the economics of the entire sector. We are also looking at why NVIDIA and Tesla are seeing downward pressure as their technical charts begin to flash warning signs to the broader market. It is a packed session of technical analysis, and we are diving into the details immediately. Open artificial intelligence has finally moved past incremental updates with the release of generative pre-trained transformer 5.5. This is the first time the base model has been fully retrained since the generative pre-trained transformer 4.5, and the target is clear. They are building a fully autonomous system designed for complex multi-step tasks. The performance metrics are truly striking for corporate leaders looking to automate infrastructure. On the Terminal Bench 2.0 benchmark, this new model reached 82.7%. That is a massive jump compared to the 69.4% we saw from Claude Opus 4.7, signaling a new era of reliability for operations. We are seeing a fundamental shift from simple wrappers to what I call true digital coworkers. With a 78.7% success rate on the operating system World Verified benchmark, this system can now navigate real computer environments autonomously. It suggests that the days of manual data entry and basic administrative friction might finally be coming to an end. Achieving an 84.9% on the General Domain Prompt Validation test shows a sophisticated ability to reason across long contexts while using tools like code executors. It sounds like a dream for productivity, but I suspect the engineering trade-offs and the actual cost might tell a much more complicated story for the developers.
The engineering reality is that this autonomy comes with a heavy price tag for every single call. While resolving 58.6% of real-world GitHub issues on the latest Software Engineering Bench Professional 2026 test is impressive, Open Artificial Intelligence has doubled the per-token pricing compared to version 5.4. Open Artificial Intelligence claims that the superior efficiency of the Codex tokens will offset those higher costs by requiring fewer total tokens for engineering tasks. However, that is a difficult promise to verify when you are dealing with large-scale production environments. Engineers need to see if the reduction in volume actually balances out that 100% price increase. Beyond the budget, I am looking at the safety implications of that operating system world success. When a model operates in a real environment, the blast radius of a single hallucination grows exponentially. That 84.9% reasoning score is not just a performance metric, but a necessary safety floor for allowing an agent to touch production systems. Even with the professional variant hitting 90.1% accuracy on web retrieval, the sheer computational weight of this architecture is hard to ignore. It raises the question of whether this brute force retraining is the only path forward. We should look at how innovative architectural shifts from the East are beginning to challenge this heavy-handed dominance.
DeepSeek version 4 is challenging the narrative that high-end engineering excellence is a strictly Western monopoly. By achieving a Codeforces rating of 3,206, the Pro Max variant has officially outperformed generative pre-trained Transformer 5.4x high. This represents a massive milestone for for the global landscape of artificial intelligence development. This capability translates into real-world utility through a massive 1 million token context window. It allows the model to digest entire code bases or complex legal archives in a single pass. For businesses, this means the barrier to entry for high-level reasoning and deep technical analysis has just been lowered significantly across the entire international market. The performance on the software engineering bench verified test is particularly telling for the future of automated development. With a success rate of 80.6% for repository-level debugging, we are seeing a system that can actually manage software projects. It is no longer just predicting the next word, but actually solving complex engineering problems at scale. What really stands out is the reduced sampling latency during reinforcement learning rollouts. These models are essentially learning to think faster in real time, which is a game changer for interactive engineering scenarios. This shift in efficiency suggests that the race for intelligence is becoming as much about speed and accessibility as it is about raw power.
Sloan, if we look under the hood of that 1.6 trillion parameter mixture of experts' architecture, the efficiency gains are even more aggressive than the benchmarks suggest. The introduction of a hybrid attention mechanism, combining compressed sparse attention and hybrid contextual attention, is what actually makes those massive context windows feasible for any organization to run. The most significant technical achievement here is the 90% reduction in the key value cache size compared to previous versions. By cutting down the inference floating point operations per second to just 27% of what was required before, DeepSeek has made 1 million token contexts economically viable. It is a masterclass in optimizing memory traffic for production. Their choice to replace the standard Atom W optimizer with Muon for core parameters is another calculated risk that paid off. By using Newton-Schulz iterations to orthogonalize gradient updates, they have maximized hardware utilization and accelerated convergence. It shows a willingness to deviate from established deep learning norms to squeeze every bit of performance out of the silicon. Even the use of floating point 4 quantization-aware training on the expert weights targets the fundamental bottleneck of memory bandwidth during sampling. However, these architectural breakthroughs still require massive underlying hardware clusters to reach their full potential. This brings us to how companies like Google DeepMind are rethinking the distributed infrastructure and fault tolerance needed to scale these systems.
DeepMind is fundamentally changing how we think about the physical limits of building these massive systems. By achieving 88% Goodput across 1.2 million chips, they have shattered the previous ceiling of 27% seen in standard methods. This efficiency means training runs are actually productive, instead of just wasting energy on synchronization. Perhaps the most transformative aspect is how they slashed the inter-data center bandwidth requirements from 198 gigabits per second to 0.84 gigabits. This effectively democratizes high-level training by allowing it to run over standard internet infrastructure. We are moving away from needing specialized, ultra-expensive networking pipelines to train world-class models. The sheer resilience demonstrated while training a 12 billion parameter model across 4 distinct United States regions is staggering. Their system can lose entire learner units and simply self-heal, reintegrating those components once they recover without stopping the entire job. This level of uptime and stability is a massive leap forward for reliable global-scale engineering projects.
Sloan, while you see the accessibility, I am looking at the unprecedented flexibility in hardware choices. They successfully mixed Tensor Processing Unit version 6E and version 5P chips in a single training job without any performance degradation. Usually, trying to sync different hardware generations creates a massive bottleneck that drags everything down to the slowest link. By utilizing asynchronous data flow through the pathway system, these learner units can perform local gradient steps without waiting for their peers. This eliminates the traditional blocking problem that plagues synchronous training at this scale. It is a brilliant way to keep the compute cycles moving, though it does introduce some interesting questions regarding the final model weights and consistency. We do see a slight trade-off in accuracy when you look at the Gemma 4 model experiments. The decoupled distributed low communication method reached 64.1% accuracy compared to the 64.4% baseline. It is a minor drop, but in the world of high-performance computing, every decimal point represents thousands of hours of training time. The engineering trade-off here is clearly favoring scale and uptime over absolute precision. While the resilience is impressive, managing a distributed system across standard wide area networks at only 2 to 5 gigabits per second requires a high tolerance for lag. It proves that we can now prioritize hardware availability and geographical distribution over the traditional requirement for centralized high-speed clusters. This shift in how we manage infrastructure suggests that the bottleneck is moving from hardware capacity to how we finance these sprawling global networks. We need to pivot from the engineering of artificial intelligence to the financial volatility of the companies building it. This brings us to a sharp look at NVIDIA and the current market consolidation. Looking at the charting for NVIDIA, the technical indicators are screaming for a breather. The 14-day relative strength index has climbed to 86.68, a level that historically signals the stock is significantly overbought. Even with the massive hype surrounding recent hardware launches, the market is overdue for a period of price consolidation. We have to account for the extreme price volatility reflected in their high beta of 2.33. While the average analyst price target sits at a bullish $268.61, the technical side suggests a 21-day sideways horizon. Investors are essentially holding their breath until the May 20th earnings report. The geopolitical risks are finally manifesting in the order books as DeepSeek is reportedly bypassing NVIDIA high-end H200 chips. They are opting for Huawei Ascend processors instead, which puts approximately $30 billion in projected revenue from the Chinese market at risk. This competition is a tangible threat to the long-term growth story we have heard. It is a stark contrast between those looming risks and the current fundamental strength the company shows on paper. I see a cooling off period as inevitable, because even the strongest engineering cannot overcome these specific technical and regional headwinds. Sloan, how do you weigh those competitive threats against the incredible profitability numbers they just posted for the year?
It is difficult to get too bearish when you look at a company maintaining a gross margin of 71.07%. NVIDIA is printing money with a net margin of 55.60%, which is unheard of at this scale. They are turning every dollar of revenue into an engine for future growth. The sheer scale of their success is evident in the 65.47% year-over-year revenue growth. With a total net income reaching $120.07 billion, they have built a war chest that few competitors can match. This cushion allows them to absorb regional losses while still dominating the global landscape. Beyond the income statement, look at the $96.68 billion in free cash flow they generated recently. Even if they lose ground in China, global demand remains insatiable, as seen by the 40% surge in H100 rental prices. This suggests that enterprise demand for high-performance computing is still outpacing the hardware supply. Their dominance in the margin space provides a blueprint for success that other players in the artificial intelligence field are struggling to replicate. As we move from NVIDIA margin dominance to the efficiency and legal struggles facing the automotive artificial intelligence leader, we find a much harsher reality. The valuation concerns and legal risks surrounding Tesla are mounting. The financial narrative for Tesla has taken a dark turn as the company grapples with a staggering 46.79% year-over-year earnings decline. which is further compounded by a mountain of regulatory hurdles and litigation regarding their autopilot software that could potentially result in over $14.5 billion in legal liabilities. Those looming courtroom battles seem to be weighing heavily on the minds of the people closest to the operations, because over the past 90 days, company insiders have divested more than $20.9 million in shares, signaling to the market that the current price of $376.30 is standing on shaky ground. We are looking at a massive $1.41 trillion market capitalization that is being tested by immediate operational inefficiencies, while a 2.93% year-over-year revenue decline suggests that the era of hypergrowth might be coming to an end, creating a difficult environment for maintaining such a premium valuation. I wonder if the engineering team can truly innovate their way out of these compressing margins before the legal costs start to drain the treasury. So I am curious, Vance, when you look at the disconnect between their current market price and the actual profit they are generating, does the math even begin to make sense?
The math is essentially a work of fiction at this point, because a price-to-earnings ratio of 348.43 is impossible to justify when you see a massive gap between the 18.03% gross margin and a net margin that has compressed to just 4.00%, even with a high beta of 1.92 indicating extreme volatility. The relative strength index stands at 61.21, which suggests some bullish momentum remains despite a 50% bearish news sentiment, and the reality of deteriorating financial metrics that experts project will continue through the year 2030. JP Morgan is not mincing words here with a severe sell rating and a projected 60% plunge in the stock price as the fundamental risks mount and operational efficiency weakens, making it hard to find a path to growth when the core business is shrinking, while the legal department is bracing for a hit. The struggle to maintain relevance while the numbers suggest a peak is a story we see often in maturing tech giants. And this marks a shift from the struggle for organic growth to the high-stakes world of debt-fueled mergers and acquisitions, as we consider the 21-day outlook for Organon and Company.
Sun Pharma is stepping onto the stage with a bold $12 billion binding buyout bid for Organon and Company, a move that feels like a dramatic rescue mission for a firm currently valued at just $2.93 billion by the public markets. This acquisition offer arrives at a critical moment for shareholders who have watched their earnings growth plummet by a staggering 78.36% over the last year, suggesting that the intrinsic value of the business was eroding much faster than the ticker reflected. While revenue has dipped by nearly 3%, the stock price has surged to $11.26, comfortably overshooting the average analyst target of $9, which paints a picture of a market that is pricing in this massive takeover premium above all else. The prospect of an exit at such a high valuation is a rare gift for investors. But Vance, when you look at the balance sheet Sun Pharma is about to inherit, does the sheer volume of their liabilities change the way you view this $12 billion price tag?
The financial weight of this deal is genuinely concerning, because Organon is carrying $8.64 billion in total debt, leading to a debt-to-equity ratio of 11.49 that would make even the most aggressive private equity firms pause for serious reflection. From a technical perspective, the stock is screaming for a correction with a 14-day relative strength index sitting at 78.22, which indicates that the buying frenzy around this potential acquisition has pushed the price deep into dangerous and unsustainable overbought territory. Even with a healthy gross margin of 53.30%, the operational efficiency is so strained that the net margin has collapsed to a mere 3.01%, showing how much the existing debt service and overhead are eating away at the core. It is a perfect example of how agentic technology and market technicals are defining the current quarter, as automated trading systems and high-stakes mergers force us to reconcile theoretical valuations with the cold reality of leveraged balance sheets and shrinking margins across the entire sector. witnessing open artificial intelligence hit 82.7% on terminal bench, with their latest Agentic generative pre-trained transformer 5.5, alongside DeepSeek, achieving 1 million tokens of context, proves the shift is real. These milestones provide a stark contrast to the exhaustion we see in heavyweights like NVIDIA as they face growing international competition.
That gap between raw engineering success and market fatigue defines our current moment. While developers are mastering agentic efficiency and training resilience, the financial world is forcing a reconciliation between those elite margins and the reality of overbought indicators. It is no longer just about the size of the model, but how effectively it operates under pressure. As we navigate this pivot from scale to strategy, the question remains whether these technological leaps can outpace the looming valuation corrections. We appreciate you joining us for this deep dive into the architecture and the numbers. We will be back tomorrow to track the next evolution of the development journal. Until then, stay curious and keep building.